Understanding the movement of stock price has been the central debate in the area of finance. Most often, there are two approaches to find the value of stock. First, the fundamental valuation, and second, through technical analysis. The fundamental valuation approach considers those aspects of security that directly affect the long-term prospects and cash flows of the underlying firm. In contrast, technical analysis focuses on short-term supply-demand forces and buy-sell imbalances that result in security price movements. This kind of technical analysis involves analyzing short-term price trends, price patterns, examination of technical indicators such as moving average and momentum indicators. In this lesson, we'll introduce trend determining techniques which form an integral component of technical analysis. A trend is a period in which a price moves in an irregular but persistent direction. It can be in the form of uptrend or downtrend. We'll discuss the Dow theory of trend determination. Then we'll define short-term, medium-term, and long-term trends. We'll discuss various techniques for identifying a trend and its reversal. These include intermediate cycles, support and resistance zones, trend lines, basic characteristics of volume in trend determination, and classical price patterns. Dow theory. In this video, we'll introduce the Dow theory of technical trend determination by Charles Dow. Dow theory's goal is to determine the changes in the primary or major movements of the market. It aims to establish a trend until a reversal is proved. Dow theory is concerned with the direction of a trend and has no forecasting value as to the trend's ultimate duration or size. The theory assumes that the majority of stocks follow the underlying trend of the market most of the times. In order to measure the market, Dow constructed Dow Jones Industrial Average Index (DJIA). The 6 basic tenets of the Dow theory are as follows. First tenet is averages discount everything. Indices like Dow Jones Industrial Average reflect averages of stock prices. These averages reflect the basic wisdom of the market, that is, aggregate judgment of the market. This kind of averaging process factors in most of the information available and captures the demand and supply in the market. Tenet 2 suggests market has 3 major movements. The market has predominantly 3 kinds of movements. The most important in this is the primary or major trend, more generally known as a bull rising or bear falling market. For example, a movement like this: primary major bull or primary falling bear trend. A primary bear market is a long decline interrupted by important rallies. It begins as the hopes on which the stocks were first purchased are abandoned. The second phase evolves as the levels of business activity and profits decline. In the third stage, the bear market reaches a climax when the stocks are liquidated regardless of their underlying value, because of the depressed state of the news or because maybe of forced liquidation caused by margin calls. A primary bull market is a broad upward movement like this, normally averaging at least 18 months, which is interrupted by secondary reactions. The bull market begins when the averages have discounted the worst possible news and confidence about the future begins to revive. The second stage of bull market is the response of equities to known improvements in business conditions, while the third and final phase evolves from overconfidence and speculation when stocks are advanced on projections that usually prove to be unfounded. Secondary market reactions or intermediate reactions like these. A secondary or intermediate reaction is defined as an important decline in a bull market or advance in a bear market. For example, this advance in the bear market or decline like this in the bull market, usually lasting from 3 weeks to many months, during which interval the movement generally retraces from 33 to 66% of the primary price change since the termination of last preceding the secondary reaction. This relationship is shown in the figure here, as we can see: rise, fall, rise, fall. falling bear market then rise. Occasionally, a secondary reaction can retrace the whole of the previous primary movement, but normally the move falls within 1.5 to 2/3 of the area, often at the 50% mark. As discussed in greater detail, the correct differentiation between the first leg of a new primary trend and secondary movement within the existing trend provides Dow theories with their most difficult problem. Next, we have intermediate cycles like this. These cycles comprise 5 to 7 intermediate trends, 3 of which form part of prevailing trend, while the remaining 2 run counter to that trend. In a bull market, the intermediate counter trends are represented by price declines. In a bear market, they form rallies that separate the 3 intermediate down waves as shown here. For example, this up move in the bull trend and a down move together comprise that intermediary cycle. The first one, which goes in the direction of the primary trend, may be called a primary intermediate price movement, while the second, which is in the opposite side, is an important price movement that lasts from 3 weeks to 3 months, occasionally longer. It normally retraces between 1/3 to 2/3 of the preceding primary intermediate trend. This price movement, which runs counter to the main trend, is called a secondary movement or reaction. Since a primary intermediate trend or price movement operates in the same direction as the primary or main market trend, it almost always lasts longer than its secondary counterpart. Its price magnitude is normally much greater as well. These counter trends or reactions against the main trend are very difficult to forecast in terms of character, magnitude, and duration. Intermediate movements can go either with or against the main trend, which means that there is an intermediate cycle similar to a primary one. An intermediate cycle consists of a primary intermediate price movement and a secondary reaction. In a bull market, the up phase of cycle should be longer in time and greater in magnitude. The low on the secondary reaction should be higher than its predecessor. In a bear market, the reverse conditions hold true, that is, declines are longer and greater while rallies are shorter and sharper but of less magnitude. Finally, we have the minor movements. These minor movements last from a week or up to as long as 6 weeks. It is important only in that it forms part of primary or secondary moves. It has no forecasting value for long-term investors. This is especially important since short-term movements can be manipulated to some extent, unlike the secondary or primary trends. These are extremely fluctuating, like this. So these are extremely fluctuating and have no long-term value. Line is defined as a price movement 2 to 3 weeks or longer, during which period the price variation of averages or indices moves within a range of approximately 5% as shown here. This often represents a digestion of gains or losses. For example, as we can see here, these lines, these are digestions of gains or losses after a down move or up move. There is a line kind of movement within a broad horizontal lines. This represents a digestion of gains or losses or a pause in the trend. Such a movement indicates either accumulation, that is stock moving into strong or knowledgeable hands and therefore bullish, or distribution, that is stock moving into weak hands and therefore bearish. An advance above the limits of the line indicates accumulation and predicts higher prices, and vice versa. When a line occurs in the middle of a primary advance, it is really forming a horizontal secondary movement. The fourth tenet is that price and volume relationships provide the background. The normal relationship is for volume to expand on rallies and contract on declines. If it becomes dull on a price advance and expands on a decline, this is a warning sign that the prevailing trend may soon be reversed. This principle should be used as a background information only, since the conclusive evidence of trend reversals can be given only by the price of the respective averages, that is, industry sector indices. Next tenet is that price action determines the trend. Bullish indications are given when successive rallies penetrate peaks while the trough of an intervening decline is above the preceding trough. For example, after rising to peak, prices are crossing this line. This is a bullish move. Similarly, this one is a bearish move. Bearish indications come from a series of declining peaks and troughs. The figure here shows a theoretical bull trend interrupted by a secondary reaction. For example, in figure A here, the index makes a series of 3 peaks and troughs. These are the 3 peaks and troughs, each higher than its respective predecessor. Then the index rallies, follows the third decline, but is unable to surpass its peak. The next decline takes the average below its low point, confirming a bear market as it does so at point X here. In example B, following the third peak in the bull market, a bear market is indicated as the average falls below the previous secondary trough. For example here, in this instance, the previous secondary was part of a bull market, so these were part of a bull market move. However, a bear market is indicated as the average falls below the previous secondary trough. In this instance, the preceding secondary was part of a bull market. This is a part of bull market. However, after this, some kind of bear indications are there. In this instance, the preceding secondary was part of bull market, not the first trough in a bear market, as shown in example A. Many Dow theorists do not consider penetration at point X to be example B to be a sufficient indication of a bear market. So this would not be considered, this fall, it will not be considered a sufficient evidence for a bear market beginning. However, they prefer to take a more conservative position by waiting for a final rally and another penetration of this here, and subsequent penetration that previous trough marked as point Y in example B. Lastly, the averages must conform. The broad market wide indices must conform with each other. For example, the one industry, let's say transport industry, should agree with goods production industry. The confirmation action is more fundamental and logical and appropriate barometer of future business conditions, because if the two indices, that is one for production, one for manufacturing, or one for transportation agrees, that means some kind of solid movement is happening, some movement which is in sync and confirmed by two indicators. To summarize, in this video we discussed Dow theory, which is concerned with determining the direction of the primary trend of the market, but not its duration or size. Once confirmed by both averages, the new trend is assumed to be in existence until an offsetting confirmation by both averages takes place. Major bull and bear markets each have 3 distinct phases. Both the identification of these phases and the appearance of any divergence in the normal volume price relationship offers useful indications that a reversal in the major trend is about to take place. Such supplementary evidence is particularly useful when the action of the price averages themselves is inconclusive. In this video, we will see the examination of intermediary cycles to identify primary trend reversals. Intermediate movements can go either with or against the main trend, which means that there is an intermediary cycle similar to a primary one. For example, this is an intermediary cycle. An intermediate cycle consists of primary intermediate price movement, which is this, and a secondary reaction, which is this. In a bull market, the up phase of the cycle should be longer in time and greater in magnitude, like this or this. The low on the secondary reaction should be higher than its predecessor. In a bear market, Conversely, the reverse condition holds true. For example, this in a bear market. Declines are longer and greater while the rallies are shorter but of less magnitude as well. For example, if we examine a reversal from bull to bear market like this one, since volume leads price, the failure of volume to increase above the levels of the previous intermediary cycles in the up phase is a bearish sign. Alternatively, if over a period of 3 to 4 weeks, volume expands on the intermediate rally close to the previous peak in volume but fails to move prices significantly, it represents churning and should be treated bearishly. There are essentially two broad characteristics that suggest that the downward phase of an intermediary cycle could be the first down leg of the bear market like this. The first signal is substantial increase in volume during the price decline. For example, if this price decline along with substantial increase in volume, the second is a cancellation or retracement of 80% or more of the up phase of that same intermediary cycle. For example, if you look at this cycle up and down, the down move is more than 80%. In fact, it is a 200% retracement of the previous up move. The greater the retracement, the greater the probability that the basic trend has reversed, especially because the retracement is in excess of 100%, means that any series of rising troughs has broken, thereby placing the probabilities in favor of a change in primary trend. Similarly, reversal from a bear to bull market like this one, the first intermediate up phase of a bull market is usually accompanied by a substantial expansion in volume like this. In other words, the first up leg in a bull market attracts noticeably more volume than any of the intermediary rallies in the previous bear market. Any sign of a basic reversal occurs when prices retrace at least 80% of the previous decline. So for example, if previous decline almost 80% of it, in fact 85% retracement is there. Again, the greater the proportion of retracement, greater the odds of a reversal in the basic trend. If the retracement is greater than 100%, the odds clearly indicate that a reversal in the downtrend has taken place because the series of rising peaks will have been broken. Since volume expands substantially as the intermediate down phase during a bear market reaches a low, a shrinkage in volume during an intermediate decline could well be a warning sign that the bear market has run its course. For example, this downward movement lacks increase in volume. For example, there's a decline in volume which suggests that bear market has run its course. This is especially true if the prices do not reach a new low during this intermediate decline, since the series of declining intermediate cycle lows, which is a characteristic of a bear market and bear market may no longer be intact. To summarize, substantial increase in the volume on secondary intermediate price movement, which is opposite to primary trend. Secondary intermediate movement or retracement is more than 60% of the primary intermediate move. Volume does not substantially increase or remains dull around primary intermediate price move, that is along with the trend. Retracement is more than 100% or a series of rising or falling peaks and troughs is broken. An important implications of intermediary cycle analysis or application in trend reversal is peak and trough analysis. Rising market move in a series of waves where each rally being higher than its predecessor, and when this series of rising peaks and troughs is interrupted, a trend reversal is signaled. For example, here we can observe a series of rising peaks and troughs. This is interrupted here. This rising peaks and troughs are interrupted here. This is a first decline or opposite move in the rising peaks and troughs, which indicates some kind of reversal, which indeed happens. Similarly, here rising peaks and troughs are observed, which is reversed here. So primary trend reversal is observed here. This rising market moves indicates series of waves. Similarly, here it's a bear run where falling peaks and troughs are observed, which is reversed here. Notice that this high is above the previous high, which is here, and the low is higher than the previous low. All signals indicating to a primary trend reversal. An important aspect of secondary cycle is the secondary reaction, and to qualify as a reaction, to the prevailing trend, the move should retrace between 1/3 to 2/3 of the previous move. For example, this to qualify as a reaction has to retrace at least 1/3 to 2/3 of the up move. In case of a lines like this, the reaction is qualified based on the duration of the line, how much time this line movement persists rather than the amplitude of this. So duration is more important for the lines. To summarize this video, a typical primary trend can be divided into 2.5 primary intermediate cycles, each consisting of an up move or down move. In a bull market, each successive up wave should reach a new cyclical high, and in a bear market, each successive down wave of the intermediate cycle should reach a new low. Breaking of this pattern of rising lows and falling peaks is an important but not a very final kind of signal, but still a warning signal that there may be a reversal in primary trend. For more conclusive proofs, the analyst should derive a similar conclusion from a consensus of indicators. A secondary movement or reaction is that part of an intermediate cycle that runs counter to the main trend, which may be a downward reaction in a bull market or a rally in a bear market. Secondary intermediate movements typically last from 3 weeks to 3 months and retrace between 1/3 to 2/3 of the previous primary intermediate price movement. Secondary price movements may also take the form of line or horizontal trading pattern. The character of these intermediate cycles can be used to identify primary trend reversals. As an approximate rule, the stronger the intermediate rally in a bull market and vice versa, the less the retracement is likely to. In this video, we'll discuss the application of support and resistance zone in identifying price trend reversals. Support indicates buying in sufficient volumes to arrest a downtrend in prices, and resistance indicates selling in sufficient volumes to stop the rise for the time. A good support point is a low in recent memory. Think of support as a temporary floor for prices and resistance. For example, point A here serves as a low in recent memory. Think of support as a temporary floor for prices and resistance as a ceiling. Point A here is considered to be as a temporary support area, as we can see here. The price finds bottom at A, moves up, then fall back on A, and again finds a support. The third time it violates the support, the price finds a temporary support in B next time. As we can see here, this B point is the next support. Again, C also proves to be a support point, but note that the rallies are reversed now, and now B becomes the resistance zone. So the support reverses its role here, as we can see the B point, to resistance on the way up. A previous high or low is a potential support resistance level, as we can see here. We see the price rally through resistance B and A. We can see here, this B is acting as resistance, and again A here acts as a resistance, which were previous support levels, and the ensuing decline then finds again support at A. So after it crosses, then again A acts as support. Therefore, resistance reverses its role to support on the way down. To summarize this, we have established that previous highs and lows are potential support or resistance level. Highs are important because various market participants may have bought close to or at the actual high for a move. When prices decline, the normal human being response is not to take a loss but to hold on. That way, the pain of actually realizing a loss can be avoided. As a result, when the price returns to the old high, those who bought at that level have great motivation to sell in order to break even. Consequently, they liquidate. Also, those who bought at lower prices have a tendency to take profits at the old high, since that is the top of familiar ground. By the same token, any prices above the old high look expensive to potential buyers. Consequently, there is less enthusiasm on their part, so they begin to pull away from the market. When a price rallies and then falls back on the previous low, these bargain basement prices appear to be potential buys. After all, they missed the opportunity the first time prices retreated to this level, and they are therefore thankful to have another chance. For the same reason, sellers are reluctant to part with their securities as prices approach the previous low, since they saw them bounce before and naturally wonder why the same process should not be repeated. In this video, we'll discuss the application of trend lines in identifying primary trend reversals. A trend line is a straight line connecting either a series of ascending bottoms like this in a rising market, or the tops of a series of peak rallies, peaks of this descending series of rallies. Those joining the lows are called uptrend lines. So this is an uptrend line, and those connecting the tops are downtrend lines like this. When the prices break above the trend line like this in a falling series of tops, then a trend reversal is given. Opposite it's true for a uptrend line like this. So if it is crossing from here towards down, then it is a signal of reversal. There are certain characteristics that are often employed to identify trend reversals with a trend line. For example, volume associated with a trend line violation or breakpoint is an important indicator. A substantially high volume or substantially high volume in a particular direction where cross is appearing is an indicator that market may be churning or taking a turn. The larger the length of a duration of a trend line, the higher the strength of that trend line, and therefore its violation is also very significant signal. More the number of times a trend line has been touched, for example, more number of time a trend line has been touched or acted as a support or resistance zone, greater its significance. However, many times a very steep up or down trend line may be broken, but it may not result in change in trend, but only a continuation pattern rather than trend reversal. For example, let us see here. Here you can see a very steep trend line is broken. However, that has not resulted in a trend reversal, but rather more of a continuation, but with a less steep trend line. Similarly, there is a corrective fan principle where a very steep trend line is violated, only resulting in a less steep trend line. To summarize, the completion of a price pattern can signify or violation of trend line, which is sort of completion of a price pattern. It can signify either a reversal in the previous turn, or then that case it is known as reversal pattern, or just the resumption of previous trend. Then it is called consolidation or continuation pattern, as we saw in this corrective fan principle. Similarly, the penetration of trend line in the opposite direction may also result in a reversal of the current trend or continuation as well. Some of the examples we have seen in this video. Thus, whenever a trend line is violated, many times odds favor a change in trend. That change can either be an actual reversal or a sideways trading range, like trading in lines, as we have already seen something like this, trading in ranges or trading in lines, following an uptrend or downtrend. Further clues to the significance of a specific trend line violation can be gleaned from volume characteristics as well. For example, if a series of ascending peaks and troughs is accompanied by progressively lower volume, it is a sign that the advance is running out of steam, since volume is no longer going with the trend. So if volume doesn't go with the trend, it is a sign that trend may reverse. In this instance, a trend violation is likely to be of greater significance than if volume had continued to expand with each successive rally. It is not necessary for a downside penetration to be accompanied by high volume, but a violation that occurs as activity expands emphasizes the bearish undertone because of the obvious switch in the demand-supply balance in favor of sellers. In this video, we'll discuss the basic principles of interpretation with volume. Volume has certain specific characteristics with a given trend. For example, it gives greater depth to the weight of evidence. Volume not only measures the enthusiasm of buyers and sellers, but it is also a variable that is independent of price in capturing the arrival of information. So when price and volume patterns are compared, it is important to see whether they are in agreement or they are in divergence. And if the probability favor if they are in agreement, then the probability favors extension of a trend. But if they disagree, that tells us that underlying trend is not as strong as it looks on the surface. A lot of clues to the significance of particular pattern or trend reversal can be gleaned from volume characteristics. For example, if a series of ascending peaks and troughs is accompanied by progressively lower volume, it is a sign that the advance is running out of steam, since volume no longer going with the trend. In this instance, a trend line violation is likely to be of a greater significance than if volume had continued to expand with each successive rally. It is not necessary for a downtrend line penetration to be accompanied by high volume, But a violation that occurs as activity expands emphasizes the bearish undertone because of the obvious switch in the demand supply balance in favor of sellers. Let's look at this diagram here. For example, falling prices and contracting volume, like here, falling prices and contracting volume is a normal situation, and rising prices and rising volume is also a normal situation. The first and very important principle is that volume goes with the trend. So it is normal for normal activity for volume to expand in a rising market and contract in a declining one. The combination of rising volume and rising price is also normal, as we saw. It indicates that things are in gear. Volume normally leads the price during a bull move. A new high in the price that is not confirmed by the volume should be regarded as a red flag, warning that the prevailing trend may be about to reverse. For example, if you look at the price trend, which is on the upside, compared with this the volume and price are in divergence. Volume is falling while price is rising, which indicates that volume is not in agreement with price, and therefore some kind of trend reversal is due, which actually happens afterwards. And therefore rising prices accompanied by a trend of falling volume is an abnormal situation. It indicates a weak and suspect rally or rising peaks and troughs, and indicator that bear market may come shortly or price trend reversal may happen. Essentially, volume measures a relative enthusiasm of buyers and sellers. When it shrinks as prices rise, the advance occurs only because there is lack of selling rather than sponsorship or force from the buyers. Sooner or later, the trend will reach a point where sellers become more motivated, and at that point, prices will start to pick up on the downside. One clue is provided: when activity increases noticeably, the prices starts to decline. Let's look at this diagram here. Please note, volume normally leads price during a bull move. For example, you can see here there's a up bull move. A new high in price which is not confirmed by the volume, like this volume is falling while peaks and troughs are rising, therefore they are not in agreement and not confirmed by volume, it should be regarded as a red flag, warning that prevailing trend may about to reverse, like this, as it is happening here. In this figure, the price peaks at point C, yet the average volume reaches its maximum at point A, after which there is a decline in volume. Rising prices accompanied by a trend of falling volume is an abnormal situation and indicates a weak and suspect rally. So this rally is suspect, and therefore it is a bear market characteristic that bear market may be about to begin soon. Notice in the second diagram also, there is a rise in price which is accompanied with a sharp fall in volume, which is bearish and is reflected in the subsequent sharp downfall in prices. So rising prices and falling volume is a bearish characteristic. Also, falling prices and rising volume is bearish, which indicate, for example here, falling prices which accompanied by significant increase in volume indicates rising or some kind of force by sellers, and therefore indicates that a bear market or fall in prices is about to happen. Also, please note the characteristic of volume change in bull and bear markets. For example, in a normal bull market, rising prices are accompanied by rising volume and falling prices are accompanied by falling volume. In contrast, in a bear market, often falling prices like this are accompanied with rising volume, while rising prices are accompanied with falling volume. So there's a very different relationship between volume and price in bull and bear markets. Often when price and volume do not agree, some kind of reversal is expected. For example, here, while the prices have risen, volume has fallen and do not agree with prices, and therefore some kind of divergence between volume and price is set up, and therefore after some time there is a line kind of movement, trading happening in line or in within certain range, and then there's a sharp fall. Also, please notice that when the prices fall, there's a sharp increase in volume on the upside. This volume expands when the prices fall, which indicates that some kind of bear run is taking place. This diagram also indicates that, notice that this bear market is characterized by volume declines as price rises. So wherever there is a rise in price, volume declines, which means volume does not agree with price when there is increase in price, because a bear market run is continuing. To summarize, in this video, we discussed that volume provides an important piece of information. Often, it provides a leading information indicator to judge whether a pattern is solid or some kind of reversal is about to take place. For example, if volume agrees with price, then it appears that the trend may continue for some time or it is solid and strong. However, if volume does not agree with price and therefore the trend is weak and may reverse. For example, we discussed that in bull market, rising prices are accompanied with rising volume and vice versa, while in bear market, the trend is opposite. Classical price patterns. In this video, we'll examine some of the often employed classical price patterns that are often used to examine the strength of a price trend. Here in the figure, we have a typical market cycle in which there are three trends. One is up, sideways and down. The sideways trend is essentially a horizontal or transitional trend which separates two major market movements, for example up and down and up. The transition between a rising and a falling trend are often signaled by identifiable trading ranges known as price patterns like this. To the market technician, the transitional phase has great significance because it marks the turning point between a rising and falling market. If prices have been advancing, the enthusiasm of the buyers has outweighed the pessimism of sellers up to this point, and prices have risen accordingly. During the transition phase, the balance becomes more or less even until finally, for one reason or another, it is tipped in a new direction as the relative weight of selling pushes the trend of prices down. At the termination of a bear market, the reverse process like this occurs. These transition phases are almost invariably signaled by clearly definable price patterns or formations whose successful completion alerts the technician to the fact that a reversal in trend has taken place, like this. This phenomena is illustrated in figure here, which shows the price action at the end of a long rising trend. As soon as the price rises above the line BB, it is in the transitional area, although this is apparent only sometime after the picture has developed. Once into the area, the price rises to the line AA, which is the resistance. The word resistance is used because at this point the price shows opposition to a further rise. When the demand-supply relationships come into the balance, the market quickly turns in the favor of sellers because prices react. This temporary reversal may occur because buyers refuse to pay up for a security or because the higher price attracts more sellers. For a combination of these two reasons, the important fact is that the relationship between the two groups is temporarily reversed at this point. A vice versa explanation can be provided by this kind of movement where prices have fallen and then again the trading is in the ranges, after which a reversal occurs. The transition or horizontal phase here, as we saw, separating rising and falling prices trends discussed here, is a pattern known as rectangle. So this is often referred to as the rectangle pattern because prices fluctuate between the rectangle, inside the rectangle. This corresponds to the line formation developed from the Dow theory. So it is similar to that line formation. The rectangle as we see in this figure, marking the turning point between the bull and bear phases like this and this, is termed as a reversal pattern. Reversal patterns at the market tops are known as distribution areas or patterns where the security is distributed from strong informed participants to weak uninformed ones, and therefore at those market bottoms are called accumulation patterns. So this is the distribution patterns where security moves to weak uninformed hands and therefore fall in prices, and here you can say this is accumulation pattern where security passes from weak and uninformed participants to strong informed participants and therefore this kind of rise in prices, strengthening of prices. Notice in the diagram here, the prices breaks to the upside, reinforcing the series of rising peaks and troughs that precede the formation of a rectangle. So after this rectangle, there is a breakout upside, thereby reaffirming the underlying trend. In this case, the corrective phase associated with the formation of the rectangle would temporarily interrupt the bull market. So there's a temporary interruption. Such formations are referred to as consolidation or continuation pattern. So there's a continuation of the earlier trend before that transitionary phase. Next, we have head and shoulders pattern that are probably the most reliable of all the patterns. They occur both at the market tops and bottoms, as we can see here in the figure. So there's a market top and bottom also. This figure, as we can see here, a typical head and shoulder distribution pattern where it moves from strong to weak hands, while the bottom one is accumulation kind of pattern. It consists of a final rally ahead, separating two smaller, although not necessarily identical rallies or shoulders like this and this. If the two shoulders were the trends of immediate duration, the first shoulder would be the penultimate advance in the bull market. So this shoulder is like a penultimate advance in the bull market, and the second shoulder is probably the first bear market rally. The head, of course, would represent the final intermediate rally in the bull market. Here, please note the volume characteristics are of critical importance in assessing the validity of these patterns. Activity is normally heaviest during the formation of left shoulder like this. So here you can see the activity is heaviest at the left shoulder and also tends to be quite heavy as prices approach its peak. The real tip of that head and shoulder pattern is developing comes with the formation of right shoulder, which is this one or this one in the opposite pattern, which is invariably accompanied by a distinctly lower volume like here. Quite often the level of volume contracts as the peak of the right shoulder is reached, and line joining the bottoms of the two shoulders is called neckline. So this is the neckline here. If you look at carefully at the figure, you will appreciate the violation of the neckline. This violation of neckline also represents a signal that previous series of rising peaks and troughs has now been broken and given way to at least one declining peak and trough like this. The right shoulder represents the first lower peak at the bottom of the move following the breakdown, a lower trough. Moreover, since a right shoulder rally should be accompanied by a trend of shrinking volume like this, one that develops under the context of heavy volume provides a clue that the top will fail. The figure at the bottom, this is a classical reverse head and shoulder pattern. This shows head and shoulder pattern at a market bottom. This is also called inverse head and shoulder, a reverse head and shoulder, or head and shoulder bottom. Normally, the volume is relatively high at the bottom of the left shoulder here and during the formation of the head. The major factor to watch for is activity on the right shoulder, which should contract during the decline to the trough and expand substantially on the breakout. So here the volume will expand in the breakout. To summarize, in this video we discussed some of the most important classical price trends, for example side up, down and sideways, top and bottom formations, rectangular patterns, reverse rectangular patterns, and head and shoulder patterns, reverse head and shoulder patterns, and trading in ranges. We also saw some of the continuation and reversal patterns, which we explained with the help of accumulation and distribution of stocks from weak to strong and strong to weak hands. To summarize this lesson, technical analysis deals with identifying temporary supply-demand mismatches. A very important development in this regard is Dow theory by Charles Dow. The theory has 6 postulations. Averages discount everything. Second, market has 3 types of movements: primary or major trend, secondary reaction, and minor movements. Third, lines indicate movement. Price and volume relationships provide the background. Fifth, price action determines the trend. And sixth, averages must conform. Moving on, an intermediary cycle comprises an up and down move in a primary bull or bear run. These intermediary cycles are very important in identifying trends and reversals. There are various price formations and patterns that are used to identify the strength of a trend and chances of its reversal. These include support and resistance zones, trend line violations, and classical price patterns such as sideways, rectangles, breakouts, head and shoulder patterns. Next, trend lines are lines connecting rising troughs and falling peaks. A down cross of an uptrend line and vice versa price movement indicates chances of reversal. Volume also offers important information in examining the strength of a trend and chances of reversal. For example, volume movements that agree with price indicate the strength of the trend. Volume movements that do not agree indicate weakness in the current trend. Price volume relationship changes its nature in bull versus bear run.